Hello and welcome to US Stocks. Today, we're moving away from consumer-facing tech and digging into the foundational, industrial heart of the next generation of technology. We're talking about Wolfspeed, ticker symbol WOF. If you've never heard of them, you've definitely heard of the trends they power: electric vehicles, 5G communications, and the entire green energy revolution. Wolfspeed doesn't make the car, they make the critical semiconductor materials, specifically silicon carbide, that allow the car to charge faster, go further, and operate more efficiently. But this picks and shovels play on the future has been a brutal investment lately. The question is this a broken company or a brilliant opportunity? We'll examine the price, the sentiment, and the critical future outlook to find out. Let's power up! Part 1. The current state of play, price and performance. As of today, October 2nd, 2025, Wolfspeed stock is a case study in market patience wearing thin. It's currently trading around the $35 mark. For anyone who has followed this name, they know this price reflects a long and painful downtrend from its former highs. The story of Wolfspeed for the past couple of years has been one of immense promise overshadowed by immense spending. The company is in the middle of a massive multi-billion-dollar capital expenditure cycle, building the world's largest silicon carbide factories, most notably the JP Fab in Siler City, North Carolina. Building these state-of-the-art facilities is incredibly expensive and complex. The market has punished the stock for the constant cash burn and the delayed gratification. Wall Street has shifted from a jam tomorrow mindset to a show me the money now attitude. The current stock price reflects deep skepticism about Wolfspeed's ability to execute on this transition from research leader to at-scale global manufacturer. It's a classic prove-it story. Part 2. The Analyst View, Price Targets. The division on Wall Street regarding Wolfspeed is stark, and it all comes down to how you model their manufacturing ramp-up. On the extreme low end, some bearish analysts have price targets as low as $25. Their thesis is simple: execution risk. They are concerned about potential delays in bringing the new fabs online, lower than expected production yields, and continued cash burn that might necessitate further capital raises, diluting shareholders. The consensus price target is hovering around $40. This suggests a moderate recovery but reflects caution. These analysts believe in the long-term demand for silicon carbide, and they know Wolfspeed has locked in billions of long-term agreements with automotive giants. However, they are waiting for tangible proof points, specifically positive news on factory output and improving gross margins, before they get more aggressive. On the high end, the bulls are looking past the current pain with price targets of $65 or higher. They view Wolfspeed as a generational company, building a moat in a critical technology. They believe the market is completely mispricing the future earnings power that will be unlocked once these new fabs are running at full capacity. They see the current stock price as a deeply discounted entry point for a company set to dominate a multi-decade growth industry. The analyst debate isn't about demand. Everyone agrees the demand is enormous. It's purely about Wolfspeed's ability to manufacture at scale, on time, and profitably. Part 3. Market Sentiment, Skepticism versus Secular Growth. The sentiment surrounding Wolfspeed has undergone a complete transformation. It has shifted from hype to deep-seated skepticism. A few years ago, WOF was a favorite EV revolution stock. Today, the conversation is dominated by concerns over its balance sheet, its cash flow, and its manufacturing timelines. The stock has a high degree of short interest, meaning many institutional investors are actively betting that the price will fall further, convinced that the company will stumble in its execution. But there's a fascinating disconnect here. The sentiment in the stock market is terrible, but the sentiment in the industrial market is incredibly strong. Major automotive and energy companies have committed billions of dollars to Wolfspeed, essentially pre-ordering their future production. So you have this conflict: financial markets that are impatient and risk-averse versus industrial customers who are desperate for the product and are planning their roadmaps years into the future based on Wolfspeed's supply. This makes sentiment a poor guide for the long term, but a powerful driver of the day-to-day volatility. Part 4. Future Outlook. The ramp is everything. Looking ahead, the future of Wolfspeed's stock price can be distilled down to one word: execution. Everything hinges on the successful ramp-up of their new manufacturing facilities. The positive catalysts, the bull case. 1. Successful fab ramps. The number one catalyst by far is positive news from their Mohawk Valley and JP fabs. Announcements of meeting production timelines, achieving high yields, and shipping product to customers at scale would be the ultimate prove-it moment and could cause a rapid re-rating of the stock. 2. Gross margin expansion. As they produce more, the cost per unit should fall dramatically. If Wolfspeed can demonstrate a clear path to achieving its target gross margins of 30, 40, or even 50%, it will prove the business model is profitable and sustainable. 3. New long-term agreements. Securing another multi-billion-dollar deal with a major EV maker or industrial player would further validate the long-term demand thesis and strengthen their backlog. The headwinds and risks, the bear case. 1. Manufacturing stumbles. Any significant delay, contamination issue, or unexpected problem in the manufacturing process is the single biggest risk. This would damage credibility, hurt financials, and confirm the bear's worst fears. 2. Competitive pressure. Competitors like onsemi and Infineon are also investing heavily in silicon carbide. If they can ramp their production faster or more efficiently, it could erode Wolfspeed's market share and pricing power. 3. Macroeconomic slowdown. While the EV trend is secular, a sharp global recession could slow EV adoption rates, potentially causing some customers to revise their orders. Conclusion. To wrap things up, Wolfspeed, WOF, is not a typical stock. It's an investment in a complex, capital-intensive industrial manufacturing company that is foundational to our electrified future. The company is at a critical inflection point. The years of spending are nearing their end, and the era of production is about to begin. The disconnect between the market's current skepticism and the enormous locked-in future demand presents both the risk and the opportunity. An investment in Wolfspeed today is not a bet on the EV market, that's a given. It is a direct bet on the company's ability to execute one of the most ambitious manufacturing expansions in the semiconductor industry. If they succeed, the current share price will look like a historic bargain. If they falter, the pain could continue. For investors, the timeline is long, and the key is to watch the factory news, not the daily stock price fluctuations. As always, this is not financial advice. Please do your own extensive research into this complex industry. Thank you for joining us on US Stocks.